The nightmare unfolds. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, contagion risk is spreading worldwide as courts are now blocking payments, threatening an all-out economic disaster. Now, if you're wondering what we're doing in the Hohai Financial District, well, we successfully evaded Chinese authorities. We win here because this could be the epicenter of the next global financial crisis. Let's head over to CNBC, where we picked today's story up with a headline: China's property giant Evergrande files for bankruptcy protection in Manhattan court. Now, I want you to understand kind of the basis of why this is such a big story, because what's going on in China, everybody believes will just stay in China. Now, you have to look back a bit here, because back in 2015, 2016, China gets the credit for pulling the global economy out of what was looking like a global recession. Now what's happened since? The global economy is again slowing down. China was given credit for being the one as their consumers came out of the COVID zero policy and we're going to pull the world out of the slump. Now they're spiraling inward. Everyone now believes that they can't pull everyone down with them. But I want you to see how quickly this risk is spreading to America, because remember, what we noticed here is these trust companies that were investing in these property developers are not getting paid, which means their investors aren't getting paid, which means whoever they owe is not getting paid. Well, now that's changed, because here it is. We're finding out that American investors are next. In a separate statement, Evergrande on Friday said they will ask the U.S. courts for, quote, recognition of the schemes of arrangement under the offshore debt restructuring for Hong Kong and the British Virgin Islands. Now, here's what this means. So what we're seeing here is they're actually dealing with offshore debt stuck over in, of course, as we see, Hong Kong and the British Virgin Islands. But that's not just the basis of it. It's not a matter of just where this debt is held. What Evergrande is asking the courts here in America to do is say, look, whatever arrangement we come up to restructure this debt, we want you to agree up front that you're going to go along with it. And that's a big step here. Let's continue on. It added the application is a normal procedure, which is indeed actually true for offshore debt restructuring and does not involve a bankruptcy petition. Well, at least not yet. The world's most indebted property developer defaulted in 2021 and announced an offshore debt restructuring program back in March, and trading of shares have been suspended since then. And they've also now filed for Chapter 15 bankruptcy protection, which allows a U.S. bankruptcy court to intervene in cross-border insolvency case. Of course, what we know now is Evergrande is absolutely insolvent, involving foreign companies that are undergoing restructuring from creditors. The aim is to protect the debtor's assets and facilitate the rescue of the business that is in financial trouble. So here's what we now know. Nobody is getting paid. But what's the big deal about Chapter 15 is what Evergrande is asking the U.S. courts to do is suspend the ability for any U.S. investor, and it doesn't matter if they're a hedge fund or a mutual fund or a pension fund, doesn't matter who owns the debt, to say that they cannot sue Evergrande in this process and that they're going to be forced to go along with whatever the restructuring is. So now we're seeing signs that, yes, we know people here aren't getting paid either, and their ability to kind of prioritize and come out ahead in this restructuring, well, that just went to nothing. And Tianji Holdings, an affiliate of Evergrande and a subsidiary, Scenery Journey, also filed for Chapter 15 protection in Manhattan bankruptcy court. So what we're seeing here now is a domino start to fall as firms are saying, hey, look, we don't want you to sue us, so we're going to get to court before you figure this out and block all of those means. So what we're now seeing is what, of course, we heard from Beijing to say, hey, there's just a slight decrease in prices here. There's really nothing going on. What we're starting to get from these property developers is a situation there is grim, maybe at best, and all of a sudden we're going to see a whole lot of people stop getting paid. As China's massive real estate sector has long been a vital engine of growth for the world's second largest economy and accounts for as much as 30% of the country's gross domestic product. So you can imagine any slowdown here has major repercussions for their economy, and anybody who stops making payments, well, that's going to affect investors worldwide. Of course, we can look back to the global financial crisis. Remember when all of those subprime bonds started going bad and people stopped getting paid? Well, everyone then believed it was just a U.S. problem, will quickly morph into a worldwide problem. as China's housing slump is far worse than reported, this from Zero Hedge, as half of state-owned builders warn of widespread losses. So now we're starting to get a hint that perhaps what's going on with just a couple of these developers, which what we've told are isolated cases, and what we've suggested on the show is where there's one cockroach or two, well, there's probably a whole bunch more. Well, now we're starting to find out that perhaps the situation there is being covered up entirely by Beijing. Earlier today, Goldman's head of hedge fund sales, this is Tony Pasquillo, noted to this point in the sequence, I'd argue the slowdown in China has been a net positive for U.S. equities with specific regard to the disinflationary impulse and the flow of capital. So let's understand kind of what he's talking about. What does Tony mean here? And we talked about this show other day when we covered China, talked about disinflation, and what did we say? People want out. They want to get the currency out, what money they have. They want to get their assets out, and where are they going to go? Well, they're going to the U.S., and that's going to kind of putting some support underneath the U.S. stock market, because you look at where you'd rather have your money right now. Well, if you're in China, you want it out and fast. That said, coming out of a week that featured another disappointing set of data and another dose of CNH weakness, again talking about currency here, it now feels like China growth fears can provoke a more global risk-off dynamic, of course something we've been warning about on this show for a long time. Well, if Tony's right, then watch out below, because the bad news out of China has become a fire hose that's not only getting more powerful with every passing day, especially if one ignores the fake official data and looks at the truth behind the surface. And consider China's official housing market statistics. We covered this just the other day, which despite falling sequentially for the first time in 2023 in July, have first been remarkably resilient in the face of tepid economic growth and record defaults by developers. New home prices slipped just 2.4% from a high in 2021, according to government figures, while those for existing homes have dropped 6%. So why, of course, would Beijing cover all of this up? Because if everybody started to know how bad it was, there would be global, widespread panic, and they don't want that. In fact, they don't want any attention on this matter at all. What they're hoping to do is somehow internally that the problem will just work itself out. We see the same kind of response from the Fed. Just restructure the loans, do this, do a few things there, wave your magic monetary wand, and maybe it'll work. And that's one of the reasons we've seen, of course, Beijing lower interest rates here, because they're hoping that will be enough. But let's take a look at kind of what the official kind of charts are. And here you can see in the primary market, a 70-city weighted average property prices fell sequentially in July, hardly move at all. But wait till we look at some of the other data, because now it suggests it's far worse. As here we see from Bloomberg, China's state developers are warning of losses as crisis spreads. Now, if things were okay, we wouldn't be hearing this, but one thing that shouldn't be facing a bunch of losses, well, that's your trading account. We're going to go back to one of these. This was from one of our subscribers that said, look, I saw all that was going on in your show about China. I looked at your CTA. I saw it was starting to shift to the downside and sell out. And I saw, of course, all of the other data. And this is the short position. You would have followed the report. I'll show you here. It moved all the way down to here. This is like a 12% gain. If you're a short seller and you like to do that, that's almost a 12% move in just a very short period of time. We're talking about 9 days here. Here you can see on the 10th, the FXI, this is a China large cap ETF, was the first indicator it was selling down. Of course, we know that once the news starts to get worse, the machines are going to move down as momentum breaks further. Here we can see on the 16th, just the other day, that now the machines on our fast algorithm, which look at a very short window, are moving into a short position. And then, of course, we note that the slow algorithm's likely to follow here, because what our whole report does, it looks at how the machines are positioned in the market. We know they can have a big effect in a short term, but what we do that's different, we run a historical overlay so you can see the extremes and know which ones, and that gives you the advantage of making a much wiser trade. Here you can see just a matter of a 12% return just by following the show, looking at the data, and checking out the report. There's a link in the description. It's a mere $30 a month or $1 a day. One trade could pay for your whole subscription. But now let's get back to what's going on in China. As 18 out of 38 owned state enterprise builders are listed in Hong Kong and the mainland have reported get this, preliminary losses in the 6 months ending June 30th, up from 11 that warned of full year losses in 2022. 2 years ago, only 4 firms with controlling or major state shareholdings posted losses. So here what you're getting out of Beijing is, there's just a mild decline in prices, and the builders are all of a sudden, hemorrhaging. They're saying, hey, wait a minute, we're taking on losses here. This is not good. This is a big problem. And yet, for some reason, the official data is different. But if what we see from these builders is right, and there's every evidence that it is, well, this contagion risk is going to spread all over the world real fast. We're going to see a whole lot more of these in the courts real quick. The warning signals state builders are no longer immune from the 2-year housing slump that has weakened the economy and triggered dozens of defaults by private peers, with speculation that Country Garden may be next. And if they are, we're talking the biggest builder going down. That means everyone else is likely to follow. Authorities in recent weeks have stepped up pledges to support the property sector, though analysts are skeptical that the measures will be enough to revive the market anytime soon. And all we've seen is a little bit of rate cuts here and a few little other things. We're not seeing, the major alarms going off. We're not seeing, the fire engines roll out of the monetary buildings and try to deal with it. And if they don't do something soon, we get the impression here that this whole thing's about to blow apart. And again, that's why we're in the Hohai Financial District here. This is the home of Evergrande. This is the epicenter of where this whole disaster is beginning. And if you don't think this can spread to the Western world, wait till we get what's going on in the U.S. banking sector here in a bit. But losses will reduce the scope to take on unfinished projects left by defaulted private sector firms, further denting homebuyer sentiment. And if people aren't optimistic or think prices are coming down, you can better believe they're not going to be buyers. And Chinese regulators see asset sales as a key step to easing the debt crisis, as President Xi Jinping's government largely steers clear of direct bailouts. And that's absolutely true. They need asset sales to fix things. They need higher prices. That's how a debt-based economy works. But the other side, as I said, if you're starting to see disaster in the space, maybe you've got a friend who bought a property, they're making payments, and there's no sign. In fact, maybe the builder's insolvent, and you're thinking, man, they're never going to get it built. There's no incentive at this point for anyone there to go buy any property. And if that happens, next thing you know, prices are going to come crashing down fast, and the whole property sector there is going to get wiped out. And then the investors around the world are next. As sector consolidation anyhow takes time, especially in a property downturn, when acquirers such as SOEs and asset management firms are demanding better valuations and sellers are not willing to dispose at a deep discount, suggesting that, as we know, prices may be actually far more illiquid and lower than anyone actually wants to admit. It sort of sounds like the commercial real estate space here in the U.S., where, of course, we know these buildings have got sky-high valuations and no one wants to buy them. Well, the reason why? It's because maybe the real value is far less, but that day will come too for the banks here. One policy tool being used to revive the housing market and the broader economy is interest rate cuts. In a surprise move, the People's Bank of China on Tuesday made the steepest cut in 3 years on the rate on its one-year loans. The central bank has also encouraged lenders to lower mortgage rates, and that is not going to make any difference. Let's take a look at this and compare it to what happens in the U.S. Let's look at this. We've got new one-family homes sold, that's in blue, against the federal funds rate. And what I want you to understand here is when you start seeing a central bank cut rates, that's never a good sign. There's this idea that, for the Fed's trying to promote right now that, hey, we're going to raise rates a whole bunch, and we're going to cool off the economy a little bit, and then we're going to back off. We're going to get into this nice normal mode of where it needs to be, and that's going to be the new space, the new bottom line for the federal funds rate. Except in history, that's never happened, never once. Once a central bank starts cutting, it usually means things are bad and about to get a whole lot worse. And here for the housing market, you can see the Fed cutting rates. That brought new one-family home sales down. You saw that here in 1990. They're just mirror repeat of each other. As the Fed's cutting rates, the economy is spiraling into a recession. You see only a small move here during the dot-com bubble. This is mainly due to baby boomers still demanding property. But look at here, the global financial crisis. New one-family homes was already selling down. The Fed finally cuts, and boy, it just accelerates this to the downside. We see the same thing happen going into the pandemic. But now the belief, of course, this coming from Beijing is let's cut rates a little bit and demand will come back. The question is, if you were in China and you were looking at buying a home, would you buy one in this environment? Well, probably not. But let's keep digging. Because here we can see new one-family homes sold. Let's, again, this in blue. Let's go a little deeper here in the data and see what really matters. If cutting the federal funds rate doesn't make a difference, well, maybe it's in the yield curve. And we start to get, what is the answer here is when banks can't make money, well, it makes lending difficult. The less loans that originate, well, the less things that are sold, and that starts to spiral down to the downside here. And what we can see is it's going back to this inversion in the 1980s. Look at that, new one-family home sold. It went down. You see the inversion here going into 1990. Boom, there you see the homes sold going down. You see it again briefly here in the dot-com bubble. Again, the effect was boomers still were needing homes, so they still bought. But look what happens just a short while later in the global financial crisis, that inversion. Just again, a pretty minor inversion. Right at the same time you see the inversion, new one-family homes sold, and just accelerates to the downside. As, of course, we know that outright erupted into a global financial crisis. You see a little bit of it here going into the pandemic. And now you get the opposite view of new one-family homes are going to go up because we're cutting rates. Well, no, the answer is the inverted yield curve's the problem, and that comes back to what is the real issue is when banks curtail lending, you start to see that effect now as banks tighten lending standards. There you go. The new home sales start to come down a little bit. It kind of happens almost each and every time. Again, this is looking at the dot-com bubble. And again, this is the baby boom effect, but look after that, you see here again, new family homes were starting to come down. But look at this, they just accelerated as banks tighten lending standards. Again, fewer homes sold because fewer banks are lending. We're seeing that happen now. The belief is, of course, from Beijing and out of U.S. investors is no, there's demand for housing. What we're saying is no, it's quite the opposite here. But that's then now pointing us right back into the U.S. banking system where everyone believes it's fine. And if you see this thing spread out of China and get all over the rest of the world, wait till you see what's going to happen because the U.S. banking system is not immune at all. And it's not because they're lending to these firms, it's because the system's largely insolvent. As large bank loan volumes shrank last week as deposit outflows reaccelerated. With money market fund assets hitting new highs and banks' usage of the Fed's emergency funds facility at record highs, we wonder how much longer the Fed can keep the dream of rising deposits alive, this from Zero Hedge, on seasonally adjusted basis. The Fed said total deposits dropped $11 billion last week, and we note that in the prior week inflow was revised higher. Now this matters because what do we know that the regional banking system desperately needs more than anything? Deposits. So if we're going to see deposits shrink, which I'm going to make the case for, it means the regional banking system, barring any sort of catastrophe around the world or even the commercial real estate disaster that's coming, it means they're in big trouble. And here you can see deposits at all commercial banks against the yield curve. And what I want you to see is the curve inverts. So what's happening here as you get this inversion, banks are actually originating fewer loans. So what should happen to deposits? Because remember, where do deposits come from? People borrowing new money. So what we should see is deposits go down. And sure enough, you see that here in the late 70s, deposits that's shown on a year-over-year rate of change, they decelerated down. And then you see it here again, kind of in the tail, toward the end of the inversion. You see kind of in 1990, that inversion as yields steepen and we went into recession, eventually that impacted deposits, which again, we view this should happen with a lag. You see it happening a little bit right here, and then the deceleration again there. You see it happen, of course, during the global financial crisis, and now deposits are going negative. They only went negative here around 1995. Now they're doing it again, and of course, the curve massively inverted. And there's another factor here that's worth understanding is because in a debt-based economy, debt gets prioritized. So money still has to go to pay debts. The issue is if we're not lending a lot, we don't have enough new money creation. Of course, deposits should be shrinking, and that is, of course, bad news for those regional banks. On the other side of the ledger, the small banks continue to pump out loans, which they're desperate to do because they need deposits to be created to plus $3.56 billion, while large banks saw a $7.4 billion contraction. So if the Fed's data is believed, small banks are winning the deposit inflows, making new loans, while large banks are leaking deposit outflows and shrinking loans. All while Treasury prices tumble, stressing small bank balance sheets. And here we can look at commercial industrial loans on a year-over-year rate of change, down now from 1.7 to 1.6% year-on-year growth. This thing is likely to go negative. Of course, we're going to make that case for you right now. And notably this, I want you to see that as commercial industrial loan growth slows, eventually deposit growth slows down with it. And it would make sense. And it would make sense it does that with a lag. So here we can see if commercial industrial loans are going to contract, that means we're going to have a further contraction in deposits and further problem, of course, with the small and regional banks. I know I didn't have that chart up there because I forgot to flip the screen over, but you can get the idea right here. You can see that relationship. And of course, it all comes back to the yield curve. When the curve is inverted and banks can't make money, what happens to those, of course, commercial industrial loan growth? It goes down. And we should see that happening each and every time. And since the curve is massively inverted here, we know this is going negative. We know money growth is going negative. And we can see it again in this effect of the net percentage of all commercial banks for tightening lending standards for firms of all sizes. And here you can see as lending standards tighten, what do you see? Commercial industrial loan growth slow. And you see it happening here during the global financial crisis. And you're seeing it now, telling us everything we need to know is that the U.S. banking sector is under deep stress. We know Chinese property developers are likely to have systemic defaults, and it's going to affect investors worldwide. The only question that remains now is how soon this all goes. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.